This time, our Diwali offering comprises a very special view from Wall Street. And today I have with me a person who can combine the flavor of Diwali, which represents the goddess of wealth, and Wall Street, which is in a way a gateway to wealth. I have with me Rupali Bhansali, one of our own, who grew up in South Mumbai, earned her spurs on Dalal Street and then moved on to Wall Street. Rupali Bhansali is Chief Investment Officer for Global Equities at Ariel Investments. Rupal, thank you very much indeed for joining me. Well, first, can you explain why the global markets have rallied so hard last week? Was it Biden or did they smell the vaccine earlier?
I have a feeling it's a bit of both, of course, but I think the vaccine turbocharged the rally. I think going into the election cycle, there was a bit of concern that the Democrats would not win. But nonetheless, I think it's reasonably clear now that they have, although it's yet to be seen. As you know, there's going to be some sort of litigation and contesting that's going on. And we can't call it over yet, frankly. But I think the vaccine is what turbocharged the markets. And in particular, I think it's more a short squeeze. Going into this quarter end, people were positioned in a very, very different way. And I think that the dollar, the currency markets and the fixed income markets have spoken, where the 10-year and 30-year treasury bonds have steepened considerably and perhaps have more room to go in terms of rate increases. And I think that sort of really caused value stocks to rally because they typically tend to do better when inflation expectations go up. So I would say that it's a reversal of momentum from what was working to what new positioning needs to be, but it also was aggravated by a short squeeze.
Okay, I got that. So this Biden stimulus and freer trade perhaps is what has charged the market. But while Biden's stimulus may or may not come, the trade has preceded it, the Biden trade. How will you play it? Will you play it with more EMs rather than DM investments?
I think the US markets actually are pretty rich in terms of the valuation, and a lot of the good news is already priced in. I would actually argue international markets offer much better opportunity. And frankly, for a decade, I have not been that bullish on emerging markets, but I finally am. And that's because for dollar investors, they care about not just the local equity market moves, but also the currency moves, because they have to see the translated gains or losses. And I would say emerging market currencies appear to be highly undervalued. That includes the Indian rupee, that includes sort of the Brazilian real. These are some of the bigger currencies in the world. And you may have noticed the Chinese yuan has already appreciated. And all of this is because the dollar is expected to weaken from its decade-long strength. And a weakening dollar typically bodes very well for emerging market currencies. It actually bodes well even for commodity prices, such as oil.
Oh. Okay, I got that. So clearly one of your Biden trades is playing emerging markets. Now, within that, what is the pecking order? Where does India figure?
I would actually say that Latin America, offers more promise to a value investor because those markets corrected harder. Asia, which has been the favorite of emerging market investors, is a bit more richly valued. That said, we tend to be stock pickers, so there's always stocks to be had in any part of the world. But if you ask me, of the three global emerging market pockets, which is LATAM, Eastern Europe, and Asia, LATAM is number one. I would say that Asia is number two. Within that, frankly, China continues to offer more opportunity. It's one of the biggest markets in Asia, of course. And I think Korea is not too far behind. But I would be a bit more circumspect on Indian equities, only because the earnings growth and frankly, the economic growth in India has disappointed even pre-COVID. And I'm not convinced that, things are likely to change. We'd have to see something very draconian or dramatic, in terms of an inflection point to turbocharge India's growth rate. Actually, economists have been perplexed. There are lots of explanations floating around, but why the Indian economy has slowed so much. It's something that needs to be addressed before earnings growth can recover. As you know, in the Indian markets, for 5 years in a row, earnings growth has disappointed, and that always is a bad setup for equity market performance.
What at all will you buy in India, if at all?
I think the financial services industry in India has been pretty beaten up. as it has been worldwide, frankly, but in India in particular, there's a whole NPL cycle and a lot of other corruption scandals and nefarious things that went on, which of course, need to kind of get addressed, which they are being addressed. But I think there are more pockets of opportunity, perhaps in financials, of very, very well managed companies, of course. I can't specifically recommend any stocks from a regulatory standpoint. I'm not allowed to. But I would say that, any industry that has been through a very difficult time, usually babies get thrown out with the bathwater. And I'm convinced that's probably the case in India, in the financial services industry. I would also say that one of the biggest things to watch out for in India is that the oil prices, which have given a windfall to the Indian financial picture, because oil is, of course, a very key commodity of consumption. The prices have collapsed in the last 5 years, and that's helped India a lot because it's a big importer. However, I see a turn upwards in oil prices, post-COVID, as things recover, post a vaccine, etc. And that's something that one should be careful about in terms of playing. The companies get adversely affected by rising commodity prices, in particular oil, and the current account deficit in India. So I think because of that, if the rupee were to depreciate or devalue, then of course, infotech and healthcare, again, being leading exporter industries, get a bid. There's so many variables to consider in investment opportunity. I can't possibly go through all of them. But I think that by and large, any company and industry that tries to define its own future through its own self-help, like TCS has done, as opposed to depend upon government or externalities, tends to drive its own destiny. And usually it's quite a haven for stock pickers.
Okay. Well, your point about India not firing too much is well taken. But still, in the month of November, we've got, by November, just in the last few days, we've got about $3 billion of foreign funds. Would you say the tide is changing, or is it that there is such a tsunami of money that this $3 billion is small change?
Look, in the very short run, these trends can be very misleading because they tend not to last. And it is chump change to have a couple of $1 billion worth of inflow. Obviously, it means a lot to India, but you're talking about a market, equity market in the world, which is almost $75 trillion strong. It really doesn't sort of amount to much. I think a lot of investors, who are contrarian in nature, are revisiting emerging markets, but they are a minority. There is a larger fraction of the world allocators who have been very disappointed with the performance of emerging markets. Over the last decade, EM has underperformed DM by quite a distance, partly because of the currencies, as I mentioned to you, which could reverse. So I think there is a great deal of apathy towards emerging markets. There was a great deal of excitement a decade ago, but that's certainly gone away. If anything, I think there is a bit more interest in international developed markets like Europe and Japan, because they also have underperformed the US markets by quite a distance. The other contrarian player, of course, everybody's talking about is, will value make a comeback? And if value makes a comeback, that has implications for sectors. So I think the move you see in India is much more a move for value-oriented sectors like financial services and cyclicals, rather than a move for India itself. Globally, the banking sector has been one of the biggest beneficiaries of this reversal trade in the last couple of days. And so India is no exception.
Thank you very much, Rupali Bhansali. Pleasure speaking with you. Thank you for joining us. Have a great Diwali and a great 2021 as well. It's almost upon us. Well, that's it on this edition of The View from Wall Street, but we have lots more such voices lined up for you.
It's time to get your dream car.
Why wait for the right time when the right time is waiting for you? Because Bank of Baroda car loan gives you 0.25% concession in rate of interest, longer repayment period, zero foreclosure charges, and higher amount of eligibility. So this festive season, own your dream car with Bank of Baroda today.
Good feelings last a few months. Good acts, more than a lifetime. Be remembered for good. Seagram's 100 Pipers. True legend.
बचाओ
पेश है बैलेंस्ड एडवांटेज फंड्स, जो बढ़ते मार्केट में आपके पैसे को बढ़ाने का और गिरते मार्केट में बचाने का इरादा रखता है।
बढ़ाओ, बचाओ, बचाओ. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Discover spirituality. Discover wonders. Discover faith. Discover art and craft. Discover heritage in Orissa. Orissa, India's best kept secret.
The gold standard in business news wins again. India's #1 English business news channel sweeps the News Television Awards with 6 wins. CNBC TV 18, follow the leader.
Your mission today, should you choose to accept it, is that we want this program to be the biggest hit of CNBC TV 18. Shankar, how much of your financial net worth is in equities and how much of that is in India?
यार बड़ा टैक्स वाला सवाल पूछ रहे हो, इस तरह की चीजें हम बात नहीं कर सकते पब्लिकली.
TV is one thing which I'm really proud of.
शेयर कोई अच्छा बुरा नहीं होता, उसका टाइम अच्छा होता है, उसका टाइम बुरा होता है. You should know when to sell. Do a lot of work, but don't put more than 10% into a single stock. That's a message that you should take away.
Very happy Diwali to Samir Bhai, Shankar and all the viewers of CNBC.
Co-powered by Appaswamy Real Estates.
My guest on The View from Wall Street now is someone who strides both Dalal Street and Wall Street with equal ease. I have with me Rohit Shah, the founder and fund manager at Makalu Investments, a company that specializes in picking mid-caps and small caps all over the world. Rohit, thank you very much indeed for joining me. Well, you know, the view from here, from India, is that Biden is an internationalist, unlike Donald Trump, who was an isolationist. So what does this mean for emerging markets? Do you think more money flows to emerging markets now?
Yeah, I know people think of it like that the election was a turning point and therefore everybody should buy emerging markets. It's safe to go into the water, the sharks are not there. But actually, this was a trend that was already taking off. The event, elections were an event which kind of shook the boat a bit, but the waters are still rising, so it's all fine. I think what you have to realize is that, let's go back to the policies and frame the discussion that way, and then you'll see what I mean. In the US, let's start with monetary policy. The Fed, 12 months back, the Fed was being accused of being Uncle Scrooge, right? I mean, their monetary policy was super tight. The bond market was just giving them hell. It was flattening away. And last month, on the other hand, the Fed's, and then we had this virus, the Fed flipped, and now we are running at 24% money supply growth in the US. Just for comparison, China and India in the last 40 years, the two fastest growing economies in the world, could barely manage 20% money supply growth in the best of their years, right? So here we have the biggest and most important central bank in the world going from being Uncle Scrooge to behaving like an emerging market central bank. So that you can imagine what that means for liquidity. Then we have the virus, which has just destroyed tax revenues on one hand and caused an enormous amount of spending from Uncle Sam and all central banks around, all governments around the world, right? So you've got very loose fiscal policy, very loose monetary policy, and these two will continue no matter who's the president of the US. On top of that, in the US, we have all been told to stay home for the last several months. So basically, people went from being a normal human being And basically they were told to go into an ashram, stay there for several months, and then now they're fed up with the ashram. They want Bollywood, and they want to spend money, and they are spending like there is no tomorrow. The U.S. alone is estimated to have spent in excess of $1 trillion over and above what they would normally spend. So 5% of GDP excess spending. These guys in the US are, they're spending on new cars. The car sales are back to sky high levels. I mean, the used car and the new car sales are sky high. New home sales, existing home sales through the roof. As you know, in any society, any economy, consumption is really about cars and homes, and those are the two expensive items. So that's happening in the US. There is no reason why human beings in other parts of the world are any different. They're all tired of staying at home and doing nothing. So, there is this massive, call it revenge consumption starting up. On the other hand, on the supply side, in the last 10 months, you had the exact opposite problem, right? Demand collapsed starting from around February. All companies around the world went on a massive dash for cash. What that really meant was companies, cut their inventories to the bone, right? I mean, they raised debt, they raised credit lines, all maxed out. Employees were cut, costs were cut, and office space was cut. Everything that you could imagine. So that process seems to have run out of steam. In other words, all the inventories that you could run down have been run down. On the other hand, what we are now seeing is this revenge consumption is coming back, and as a result, you're beginning to see a very powerful recovery starting up, slowly but surely around the world. And you're already seeing that in China, for example. China took the virus hit first. Being China, they pretty much shut out the rest of the world for all I can say. And their economy has not only recovered, it's actually higher than the levels it was 12 months back. India is back to where it was 12 months, despite the most insane shutdown that you could ever imagine of 1.4 billion people. So you're already seeing emerging markets come back, and emerging markets, health-wise, had the best outcome, so to speak, right? I mean, you can see that in the shopping videos coming out of Delhi and Bombay. I mean, nobody even cares about the virus anymore. So India and China and other emerging markets, they're doing relatively much better health-wise. So if you think in terms of an economic impact of this virus, it is more like a cyclone came and sat on your head for months, right? What that really means is that if your cyclone hits you, that's like a loss of capital. And for emerging markets, what that meant is that basically, you ran down savings, and if you had an income, right? And for 90% of people in the world, they kept their jobs, right? The 10% who unfortunately lost it, most of them were actually marginal to the economy. So the economies around the world had a better sort of outcome than people expected. And so yeah.
Okay. Well, thanks for that perspective. But now our viewers will want to know, what are you buying in India, Rohit?
Okay, so let's start with the US dollar, because the US dollar is key to many things that happen in financial markets. As I said earlier, money supply in the US M2 is growing at 24% year over year. US is running enormously loose, incredibly loose monetary and even fiscal policy, and we've got a very low inventory level all over, right? The dollar, therefore, is headed for a fall against practically every currency in the world. A key currency to watch is the dollar, Chinese renminbi, because that is what really is like the ringleader, if you will, of emerging markets. I think the dollar will have a hard time against the RMB in the next several months. That is music to the ears of currencies like the rupee, Australian dollar, Canadian dollar, all the commodities currencies, all the commodities, because China is still urbanizing rapidly. India is going to urbanize as well. So, the dollar is telling us that things are looking very good for emerging markets. Or that's the second thing is, as I said, that there's a massive inventory rundown, and now therefore you will have to rebuild inventories. Yeah. And so what you should expect to see is a steepening yield curve around the world. I would call it a bear steepening, right? The yields go up, despite the fact that the Fed will do nothing for many, many months. That is very bullish for emerging markets. You've got very loose monetary policy, rising commodity prices, economies which are coming out of a policy-induced coma, if you will, rather politically induced coma. Sorry, right, not policy, but politically induced coma, and this is phenomenal for countries like India and China. You're already seeing it in China. Any company that caters to the upper, say, 40% of the population has done phenomenally well. Their sales are going gangbusters. India, at the same time, is going to be a huge beneficiary of all this. Valuations are still very low. And I think you should assume that what happened 10 years, over the last several decades is the pattern that will happen again. Just to give you a sense of what I mean, in 1990 to 2000, in the 10 years that you were investing, the only place to make money was in the US tech stocks. Emerging markets had a lost decade. And next 10 years, 2000 to 2010, was the other way around. That NASDAQ was the dog of the decade, and emerging markets like India were the stars. Then you were given back to being dogs in India and China for the next 10 years, the NASDAQ being the star. I think now, while the NASDAQ may not be the dog, I think leadership will transfer to emerging markets, China and India as the key beneficiaries amongst them.
Got that, Rohit. Now, you are known as a master mid-cap picker, and the mid-cap index has clearly underperformed Sensex and Nifty in India. What mid-caps look attractive to you, sectors or stocks?
Let me give you a general framework for looking at Indian stocks rather than focusing on any particular stock, because I think that will be most helpful for your viewers. Sure. India is like any other country. What works in the rest of the world will work within India, except for a few specific things for India, related to India. So, in any stock market in the world, only 5% of companies make all the money. Right? Okay. These 5%, call them super stocks, have a certain common set of characteristics. First, they're very profitable. Returns on capital are well above cost of capital. Second, they grow very fast, whether that be sales growth, balance sheet growth, whichever metric you want to look at. Third, they tend to be addressing a large addressable market, right? In other words, whatever product or service you're selling should have a huge market. And the bigger the market, the more excited the stock market. India, by that metric of huge addressable market, is like a dream come true, right? I mean, how many places in the world will you see a population as impoverished as India and going for $10,000 per capita GDP in the years ahead? So you have a very large address. The fourth thing is that it should be what MBA speak would be blue oceans. In other words, markets which are new markets, think Google search 20 years back, or Facebook 15 years back, or private banking in India in a country which is full of dinosaur state banks 20 years ago. So that's another important metric, right? Those are all characteristics which are true for looking at Indian stocks. Now, what do you want to avoid in India? First is, avoid any company that depends on netas and babus of India. The netas and babus of India have a track record of destroying private sector companies which depend on them. And you can see that in the non-performing loans of the state-owned banks and what have you, infra projects, right? I don't need to tell you and your viewers how horrific a story that just makes you cry when you look at these things. The second thing is avoid value traps in India. Avoid stocks which are just cheap, because India is a very difficult market to operate in, but it is a very lucrative market. So a good company, just to throw in an example, Asian Paints would be growing, rapidly, and they can continue this growth for a very long time, right? Could they grow 20% for the next 10 years? No problem, right? You've got an economy which is just dying out for paints.
Absolutely.
Right. So I think you just avoid those value traps, avoid state-owned companies in general, avoid bonitas and bubbles, and literally, it shouldn't be too hard to find the 5%.
Okay, thank you very much, Rohit Saha, for giving us those useful lessons on how to pick stocks, for giving us a great international perspective, and for making us feel so good about the future. Have a great festival season yourself. Well, and that's it on this edition of The View from Wall Street. Thank you for watching and have a great Diwali.